Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Shikhar Garg. Now, we have had somewhat a calmer week last week with not many data releases and activities. Rather, even the market participant seems to be calming down, knowing the pace of rising borrowing rates is losing steam. That this month's trading range has been quite tight, almost a 9-year lows in the absolute point term for the Asia Pacific, but it's the geopolitics and the rest of the things which is keeping market participants on the alert. Rather, it's the debt ceiling negotiations which has kept the anticipations of another round of volatility for the market participants. The US 5-year CDS continues to rise. So, JK, I'd like to know from you, how do you think this week should be going?
Good morning, Shikhar. Yes, as you said, it was a very tight ranged market all across last week. Be it yields or stocks or even currencies also, it looks as though the market is waiting for something to happen. But definitely, there are some things which are, actually building up on the news. So we had, this. Um, Tax collections, which the market is watching very closely. And for the fiscal year 2023, so far the collection has been much less than what they had Fed, rather the Treasury has collected last year. And the reason why we are focusing on this is that that indicates the funds available with the Treasury to meet their commitments, and with the debt ceiling talks still in a stalemate. Any reduced fund means that the X date will come nearer, and now more and more people think that this is the risk that cannot be dismissed on the debt ceiling. So that's reflected in the 5-year CDS rates rising to 51 basis points, which is the highest in 2012. And also, markets are more and more assessing whether, the S&P and the Fitch will get into an act if there is any untoward, unprepared for event of a default by the US government. In the meanwhile, politicians are sticking to their guns. Republicans are going ahead with their proposed, spending cuts and debt approval, and Biden is very clear that there will be no revision to any of their spending, and the debt needs to be. So it's really a clear stalemate. Then there, one more thing that has happened is also the revision guidelines on branding certain financial firms are systemically important to reverse some of the relaxations that came about during Trump era. And these revisions to the assessment framework aims to enhance the ability of the regulators to address financial stability risk. This is really a fallout of the banking crisis that we have seen, and the potential change is to see how the banks and regulatory capital measures reflect unrealized gains and losses for the securities available for sale. So the implication of this is that the markets or the securities market can become a bit more illiquid. And on the positive side, it is expected to improve the investor confidence. So these are the two developments that the market is watching. The other one, of course, is the BOJ policy meeting this week with there is a news that says the Bank of Japan is undertaking a comprehensive study of their monetary policy over the last 3 decades, and why the Japanese economy is still in a slump, or rather it's a low growth economy despite following the zero interest rate policy, and also ultra loose policy for more than 2 decades. So that is something that is being taken up, and coming ahead of the policy meeting, we really have to see what implication it has got, whether they feel that the yield curve control and other loose policies have not worked, and so will they dispense with or relax any of these. That is something that the market is closely looking forward to. Yes, there were some data on Friday on the PMI, particularly in the US. It was a big positive surprise. because the services sector formed up more, and the manufacturing sector, which was actually slowing down, showed a growth, and it came to 50.4. And as we all know, the dividing line is always 50 between expansion and contraction, and that really took the market off guard, because everyone was looking at a weak economy. But I think the picture that we're getting from US economy is really one of mixed nature. And this PMI actually, pushed the yields up and the dollar up also, although dollar did not hold on to those gains. On the other side of the Atlantic, we did have the PMI in Eurozone also going up, both on the services and the manufacturing that, market is closely watching out for. So now, if you look at the dollar, it's really putting up a very divergent performance. Euro and GBP are doing very well. This is because not only those two economies are doing well, but also because the rate hikes by US will be more than matched by these two countries. Therefore, Euro and GBP are staying firm, but the commodity currencies are on the weaker side because of recession fears. And the Chinese currency is standing out as one of the weakest because of the geopolitical considerations, and also the fact that China and Japan are the only two countries which are still in a easier policy mode. So naturally, investors tend to sell these currencies and buy more high-yielder currencies. So that is what is reflected. Otherwise, dollar, in fact, not just the dollar, all the financial market segments are in a very narrow range. We have some important events like GDP growth for the US, and then the PCE core inflation, and possibly we have some news out of the BOJ meeting as well. So I think the narrow ranges eventually lead to big moves. So be prepared, and probably is the time to go in for some walls paying, or rather buying outright options. Just out on the rupee, I think we're still governed by the flows, and also what RBI does on the, whenever there is a flow. So we while we are seeing some outflows from FIs, we are hearing of good inflows on account of funds raising by corporates. So that's keeping the rupee in a very tight, balanced range. Just interestingly, the minutes of the RBI policy meeting held last was showing that most members felt inflation is likely to moderate from current levels, and more importantly, core inflation may also soften. The core inflation has actually eased sharply to 5.95% year on year in March, and now the market is actually looking at RBI to pass in June as well. The governor, in fact, has said that the cumulative effect of MPC actions were still unfolding. So we have a policy pause from India, following a couple of other major countries like Canada and Australia. It is the major countries like US, Europe, and UK that are still on the anvil of further rate hikes, while we are still waiting for Japan and China to move on to tighter policy mode, really depending upon how the inflation and growth evolves those countries. Really, we are looking at different segments of the world financial market and the policies. Thank you.
Okay, JK, that was good. And yes, folks, there are certain things which has kept market participants on their toes, with debt ceiling negotiations being one of the reasons or the factors which cannot be dismissed according to the market participants. On the other hand, we have the BOG policy meeting today, not today, this week, which is being anticipated by the market participants, that the BOJ is looking for reasons of slow growth, even though they had a stimulating policy stance for years, and they've been studying their economy for the past 3 decades now. But it's the Eurozone PMIs which are rising and giving a good set of numbers for the Eurozone. But and also the impending recessions have kept the commodity currencies on the weaker side. So we can definitely expect the narrow range to be one of the outcomes of the impending recession anticipations. Finally, it's the minutes of the RBI meeting last week released, which states that the core inflation can soften and the central bank continues to observe the policy effects to unfold, and this has kept the RBI on close tabs with respect to managing the volatility into the market. So that's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.